Just like the good old days, we finally had a day where the market rallied and the Fed talked. We've had pretty treacherous days the last few times the Fed talked. But today we had a pretty broad rally after initial selling. And lucky for us, energy stocks were the best performing sector of the day, like they have been of the year thus far. What am I taking away from today's Fed meeting? One important, crucial thing that sets the tone for the increase in interest rates, and I think can levitate some of the fears off of us for now, and at least give us a little bit more clarity and roadmap on where markets and the Federal Reserve are going from here. And that one thing I'm talking about is, quote, the road to normal is long. So Fed Chair Powell said, we're going to start normalizing monetary policy. I don't think that was a surprise to anyone. We're obviously in a very dovish state right now. We have been in a very dovish state, and inflation's up. And a normal policy has a little bit more hawkish state relative to interest rates. So if we're going to normalize, we're going to see rates tick up, and that was starting to happen. But we have a whole lot to go. So he's right, and it sounds like he needed to say that and remind us and the market that it is going to be a long road to normal. He's not looking to get there as soon as possible, which I think might have been the fear for some and was certainly something I was thinking about and am now no longer thinking about. And I'm altering my assumptions to reflect a longer path to normal. And I think that's something you should do too. We definitely are going to go there. But it's going to be a longer path to normal. Like Fed Chair Powell said, he expects us to remain in a low interest rate era. So while we may be on the road to normal, it is a long road to normal. So how are we positioning? Well, today we're experiencing a phenomenal day. We got the energy mining company bucket. Mining companies taking a little bit of a pause here. They had a very good week last week. Energy companies having a very good day today. Fantastic day today. We like this bucket. We're sticking with this bucket, not playing a whole lot in this bucket. What we are kind of playing with a little bit is our 10x growth companies bucket. We've not sold these companies. They have been taking a hit, and it's been painful. And there have been periods, at least for me personally, based on my positioning, where I've had both these buckets struggling. And that was painful. But what I did not do was sell these companies, the 10x growth companies that I have done fundamental analysis on, understand very well, and believe in the futures of. The products, the technology, and their ability to have an impact on the world. I still like that bucket, regardless of where interest rates go. I know that whole interest rate calculation, fund flows, etc., but I think going from 1.3% to 1.7% does not have an impact in the long run on a company that, one, can adjust its sales price for inflation, and two, that is going to be growing at some 50% or so. 10x growth, that means 10x over a long enough period of time. 20 years, 50% a year, 10x, just about. I don't know if I'm close to that. If you get the same and just do it in a nominal term calculation. Anyways, this bucket, now that the Fed has shifted to that, I expect may have actually hit a bottom. Yesterday, I was a little more hesitant to call a bottom. Wanted to say nibble, just nibble. Prices are good. If you have a company you like and it's cheap, yeah, nibble. And today the market was down again. But after hearing Fed Chair Powell, I think this is an okay bucket to start buying. It's going to be volatile. This year is going to be volatile. Mega cap tech, I still think is quite expensive. I heard a very fantastic point, which really made me consider this notion today. And that's that the mega cap techs are actually, arguably, the highest predictable cash flow companies. They are the most consistent out of all S&P 500 companies in churning out cash flow. I thought that was a very good point. Maybe investors are going to pay up for that, but I view them as very expensive. And I'd rather own energy. In my opinion, yes, energy does have more volatility in terms of earnings and cash flow. That's for sure. We're beholden to the price of oil, which is volatile, as I'm sure you guys know. But we like those companies, and they pay bigger dividends, and they make better earnings relative to the valuations. So we're sticking with that when it comes to earnings, and we're looking for bigger growth and bigger potential, essentially, when we're looking for potential. So that's our positioning. We think the mega cap techs can pull back. That's not going to affect the potential of these companies. It probably will affect the price, maybe, but they are down so big at this point that if you find a good one, you've done the fundamental analysis on it, as we discussed in Friday's video, I think it's okay to be nibbling on the way down, but if we're on the way up, still be nibbling. So that's today's video. As I realize some gains over here, I'm going to deploy some gains over here, and right now I'm not afraid to have a little bit of cash. It's been very choppy and sloppy in various areas of the market. Obviously not for energy, but cash seems like a pretty decent thing to have right now. It's possible we get a bigger correction. Not saying the bottom's in. Not all the way enthusiastic right now. I'm just saying we're being cautious. We're thinking long term. And on names we like, we'll nibble on the way down, being okay to assume they keep going down. That's today's video. Until next time, peace out.